What would happen if one country suddenly stopped the flow of oil to the world? No warning, no time to react, because this isn't just about energy. It's about how fragile the global system really is. And if that system breaks, everything changes. The day the oil stops, what would happen if, overnight, the flow of oil from one of the world's most powerful producers simply stopped? No warning, no gradual slowdown, no time to prepare, just silence. Because this isn't just a hypothetical scenario. It's a possibility that has been quietly sitting in the background of global geopolitics for years, and almost no one fully understands how big the consequences would be. Because oil is not just another resource, it is the foundation of the modern world. It powers transportation, it fuels industries, it keeps supply chains moving, it connects economies across continents. Remove it, or even disrupt it, and the effects don't stay local, they spread fast. Now imagine this. Russia, one of the largest energy exporters on the planet, decides to cut off its oil supply completely. Not reduce it, not redirect it, but stop it. At first, it might seem like just another geopolitical move, a tactic in a broader conflict, a temporary disruption. But that perception would change, almost immediately, because global markets don't wait, they react. Within hours, oil prices would surge. Within days, energy costs would spike across entire regions. And within weeks, the world would begin to feel something much deeper: instability. Because modern economies are not built to function without continuous energy flow, they depend on it. Every truck delivering goods, every airplane crossing borders, every factory producing essential materials, all of it relies on oil. And when that system is disrupted, the consequences don't unfold slowly, they cascade. That's the part most people underestimate, because they see oil as a commodity, something that can be replaced, substituted, adjusted over time. But in reality, it is a system, a tightly interconnected network where disruption in one part affects everything else. And Russia sits right at the center of that network. This is what makes the scenario so dangerous. Not just the scale of the supply, but the timing. Because the world today is already under pressure, supply chains are fragile, economic systems are stretched, geopolitical tensions are rising, and in that environment, even a small shock can trigger large reactions. So what happens when the shock is not small? What happens when it's one of the largest energy suppliers on Earth, pulling back completely? That's when things stop being theoretical and start becoming real. Because the first impact wouldn't be political, it would be economic, immediate, measurable, unavoidable, and from there, everything else follows. In the chapters ahead, we're going to break this down step by step, how dependent the world really is on Russian oil, what happens in the first hours and days after the cutoff, and why this scenario could trigger a chain reaction far bigger than most people expect. Because this isn't just about oil, it's about what happens when the system that holds everything together is suddenly pushed to its limit. A world built on dependence. To understand how serious this scenario is, you first need to understand one thing. The world is far more dependent on oil than it wants to admit, and even more dependent on specific suppliers than it realizes. Because global energy is not evenly distributed. Some countries produce, others consume, and in between lies a complex network of trade, transport, and strategic relationships. Russia sits right at the center of that network. For decades, it has been one of the largest exporters of oil and energy in the world, not just in volume, but in reach. Its oil flows across continents, into Europe, into Asia, into emerging economies that rely on stable, affordable energy to grow. And that's where the real dependency begins. Because it's not just about how much oil Russia produces, it's about how integrated that oil is within global systems. Refineries are optimized for specific types of crude. Pipelines are built around established routes. Contracts, infrastructure, and logistics are designed for continuity, not sudden change. In other words, the system is not flexible. It is efficient, but fragile. That's the trade-off globalization created. Maximum efficiency, minimum buffer. So when a major supplier like Russia is removed from that system, you don't just lose supply, you lose stability. Now some might argue that the world can simply replace that oil, find new suppliers, increase production elsewhere, adapt, and to some extent, that's true, but not instantly. And that's the problem. Because energy markets operate in real time. Demand doesn't pause. Consumption doesn't slow down just because supply is disrupted. the world keeps moving. And if the energy isn't there, something else has to give. This is where the dependency becomes visible, not in theory, but in consequences. Countries that rely heavily on imported energy would be hit first. Industrial economies, transportation networks, entire sectors that operate on tight margins and constant flow. And as prices begin to rise, pressure builds, not just economically, but socially, because energy costs don't stay in one place. They spread. Higher fuel prices mean higher transportation costs. Higher transportation costs mean more expensive goods. More expensive goods mean inflation. And inflation affects everyone. This is how a disruption in one part of the system transforms into a global issue. But there's another layer, a deeper one, because dependency is not just economic, it's strategic. When countries rely on a specific supplier, they are not just trading resources, they are entering a relationship, one that can be influenced, leveraged, used, and that's exactly what makes this scenario so powerful. Because if Russia decides to cut off oil completely, it's not just removing supply, it's testing the limits of that dependency, testing how quickly the world can adapt, testing how much pressure global systems can absorb before they begin to crack. And right now, those systems are already under strain, which means the margin for error is smaller than ever. So the real question is no longer whether the world depends on Russian oil, it's how it would react when that dependency is suddenly exposed. Because in the next chapter, we're going to explore exactly that, the immediate impact. What happens in the first hours, the first days, and why the initial shock could be far more intense than most people expect. The immediate shock. If Russia were to suddenly cut off its oil supply, the first reaction wouldn't be political. It would be instant, and it would be economic, because global markets don't wait for explanations. They react to signals, and a complete cutoff from one of the world's largest oil exporters is the kind of signal that triggers panic. Within minutes, energy markets would spike. Traders would scramble to assess the scale of the disruption. Buy orders would flood in. Prices would surge, not gradually, but violently, because uncertainty drives volatility. And in this scenario, uncertainty would be everywhere. How long will it last? Is it temporary or permanent? Can supply be replaced? No one would have immediate answers. And that's exactly what makes the situation unstable. Because when markets don't have clarity, they assume the worst. Oil prices could skyrocket to levels not seen in decades. And once that happens, the shock doesn't stay in the market. It spreads, fast. Fuel prices at the pump begin to rise almost immediately. Airlines face sudden cost increases. Shipping companies adjust rates. Industries dependent on energy begin to feel pressure. And within days, consumers notice. Because everything becomes more expensive. Transportation, food, goods, all rising at the same time. This is where the economic shock turns into a real-world impact. Because inflation doesn't feel like a number. It feels like pressure. Pressure on households. Pressure on businesses. Pressure on governments. And that pressure builds quickly. Now add another layer, financial markets. Stock markets do not respond well to instability, especially when it affects something as fundamental as energy. Investor confidence drops, markets become volatile. Sectors heavily dependent on energy, transportation, manufacturing, logistics, begin to decline. And that creates a ripple effect across the global economy. Because when key sectors slow down, growth slows down. And when growth slows down, fear increases. This is how a supply shock becomes a financial shock. But it doesn't stop there, because governments now face immediate decisions. Do they release strategic reserves? Do they impose price controls? Do they intervene in markets? Each decision carries consequences, and each one signals something to the rest of the world. Strength or weakness, control or instability. And in a moment like this, every signal matters, because other nations are watching. Competitors are analyzing, and allies are reacting. This is no longer just an economic issue. It becomes geopolitical, because energy is not just a commodity, it is leverage. And when that leverage is suddenly pulled, it forces the entire system to respond, quickly, sometimes too quickly. That's the danger of the immediate shock, not just the scale of the impact, but the speed. Because systems under pressure don't always behave predictably. They overreact, they destabilize. They reveal weaknesses that were hidden under normal conditions. And once those weaknesses are exposed, they are difficult to contain. In the next chapter, we go even deeper into the chain reaction. Because the initial shock is only the beginning, what follows could reshape the global economy in ways few are prepared for. The chain reaction.